Welcome. I'm very happy to meet you here today with the CEO and founder of Creditas, Sergio Furio. As you all know, my name is Dave Nangle. I'm the CEO of VEF. This is a call for VEF shareholders and friends of VEF. And what it is it's the first in a series of calls we're doing this year with our portfolio companies to basically update you, the investor, on our private portfolio and also increase the transparency in what is a private set of companies and just get you closer to the action and what's going on under the prism of our NAV. As you know, we ourselves had our Q4 results out last week, and our NAV in US dollars up 7% quarter on quarter and over 20% year on year. And a lot of that was actually down to Sergio Furio and his friends at Creditas, who had a standout year in terms of performance and also a benchmark fundraising Q4, all of which we've communicated to the market. But Sergio, welcome. How goes?
Thank you very much, Dave. Glad to be here, and thank you for the opportunity.
Super. Good man. No, it's good to have you, as always. So let's see this, Sergio. From a presentation point of view, you've done this 100 times, but it's a function of updating the investor base on what happened in 2025, why we're in a good place, putting that in the context of the journey so far, and why we should be excited by the outlook from here. And then I'll jump in when you're done, and we can go back and forth in Q&A, but the floor is yours.
Perfect. Thank you very much, Dave. So I'm going to try to just summarize everything in 10 to 15 minutes, and then we can jump into the Q&A. So for those of you that have been following us for a while, this is going to sound familiar, but it's still worth, at least for us, to just remind ourselves why is it that we are here. We are attacking a very clear anomaly in Brazil and in Latin America, and actually that is even valid for other emerging markets. You can start at the right-hand side. The US today has $18 trillion of consumer debt at 6%. That's 2-3 percentage points of a spread. Brazil today has $726 billion in consumer debt at a 41%, which essentially is a 25% spread. 2% versus 25% spread. I think that's the magic number that we always follow. It's normal that you have higher rates in Brazil because it has higher inflation in general. What is not normal is to have such a big financial margin. And the expected losses are not explaining that type of discrepancy. In the middle chart, we double click on why is it that this happened and what's the breakdown of the different categories in the market. So you take those $726 billion and do the breakdown, you can see that there are like 4 categories that essentially represent $145 billion. You have that in the green box, $145 billion at 141% APR. That's obviously eye-watering type of number with massive spreads. This is what is subsidizing the entire banking industry. If you take those 4 categories from the net income of every single player in the industry, the incumbents and the newcomers, the Nubanks, PicPays, Agibanks, and the Itaús, Bradescos, Santanders, and the like, essentially they have no net income. So that's why we believe that it's such an interesting opportunity. No one wants to disrupt that industry except for Creditas with the passion that we do it. And in terms of how to do that, you can see that on the left-hand side, we believe that collaterals, which is what allows you to move from unsecured lending into secured lending, it's a massive opportunity in the country. You have the mortgage penetration is 34%. 70% of the cars that are in the country have no financing attached to it. You have close to 50 million private sector employees still underbanked from a credit standpoint. So plenty of things that we believe that we can do. And this is a mission that we have been on for the last 13 years. Today, Creditas is a technology platform that provides credit, insurance, and investments in 3 verticals: home solutions, cars, and employee benefits. Obviously, the collateral is at the essence of what we do. And from there, we have expanded into adjacent territories, which helps us in improving our unit economics and improving the long-term profitability of the business. All this happened in a very unique digital platform, which is simple, easy to access, and that provides affordable credit. This is our current product portfolio: car equity and home equity as our core flagship products. Then came private payroll loans, car financing as an adjacency to what we do to allow people to purchase the car. But remember that most of what we do, it's on the first three products: car equity, home equity, private payroll loan, which has an objective of providing liquidity to the individual. On the right-hand side, the two consumer solutions type of products: insurance brokerage, where we have the largest digital insurance independent broker in the country for car insurance, and then consumer solutions, which includes our rental guarantee and our benefits card. All those products that are on the blue side, we don't really care that much about monetization. What we care is about customer engagement. It's a way of reducing CAC, increasing conversion, making sure that the customer stays with a sticky value proposition to that audience. Today, Creditas, after founding the company in 2012, today we are headquartered in Sao Paulo, although we are a fully remote company. 1,900 people. Remember that at the peak we reached 4,400 people. We will talk a little bit about that in a second. The latest numbers that we have published, and probably during February we're going to be publishing Q4 results, which as David was saying before, they ended up in a very positive note. But the last 12-month revenues were at $450 million. Run rate, we are today at $480 million in revenues, roughly 2.2 billion reais approximately on the top line. We do that through 450,000 active customers. Remember that we are in an industry with 50 million people having unencumbered residences, unencumbered cars. So you're like at that 1% of where you want to be, roughly speaking. So in the very early innings, some digital banks talk about that and already have tens of millions or even hundreds of millions of customers. In our case, again, we're just scratching the surface. It's a very different dynamic growing this type of business than a digital bank. 14% quarterly revenue growth rate year on year. That was on Q3, accelerating, as I was mentioning, in Q4. A portfolio of credit at $1.4 billion with a gross profit margin at the cohort level at 47%. You know that there's a difference between cohort level and accounting level. In the accounting level, you have like the trailing effect of IFRS. We always like to decompose it and just to make sure that we are clear about where we are seeing the actual profitability of our loans, not necessarily with the front loading of IFRS provisioning. Our revenue is at more than $1,000 per customer, which is a very differentiating KPI when you compare it to other fintech players. Very sticky trajectory of growth. Yes, it's true that in 2022 and 2023 we adjusted the pace of growth, and we did that to expand margins. Every time that we slow down growth, suddenly margins come up. Also, it's like the repricing of the portfolio in that era with interest rates coming from very low levels, 2%, to very high levels, reaching a peak at 15%. And then since 2024, with the company already in a cash flow positive, already turning the corner, re-accelerating the growth, and progressively moving to what could be a target of 20% plus for the foreseeable future. We think that the market is not the restriction. We set ourselves our restriction in terms of cash consumption, how much do we want to recognize in terms of provisioning for the new loans that we are originating. As Dave was mentioning before, we closed in Q4 our Series G, first closing at $108 million, $3.3 billion valuation. Sometimes we get asked the question of, that valuation 3.3 compared to the one that you had in Q4 21, Q1 22, that was $4.5 billion. How do you feel about that? And the reality is that we feel that this reflects the current reality of the company in the current multiple environment that we live in, and the way that public investors are looking at companies like Creditas. Back in 2021, we were at run rate revenues of half or even less than what we are today. A tiny gross profit compared to where we are today, and almost 3 times more headcount than where we are today. So very proud about that transition, the transformation that we have done at Creditas. I don't think that what we were doing at that point was good or bad. It was like a testament of our reality in the ecosystem, that we took the opportunity to grow the company at a scale. Remember that 2 years before that, you had like a tiny business. And even Dave, when you joined, guys, Creditas as investors and as a board member. That was back in 2017 with our Series C, and that was it was a business that was essentially $8 million in revenues compared to today's close to $500 million. So very proud, obviously, about the journey and how, regardless of where the market is at any point in time, it's a tailwinds that we are seeing every single year. The reacceleration, you can see that very clearly in these two charts. On the right-hand side, the origination volumes. You can see that in 2022, we started decreasing origination intentionally so that we could refrain ourselves from growing the portfolio. The impact, you can see it on the left-hand side. We wanted to keep the portfolio stable for almost 2 years in order to expand margins, build a more solid foundation, and then since Q1 24, reacceleration of origination. Q4 25 is going to be an absolute record historical of Creditas with much less resources, but with higher volumes than ever before. So we feel that this type of origination, it's a good steady state as of today, and that helps us in increasing the portfolio on a more sustainable pattern. I'm going to skip this slide. I can come back later, but just strategically, we are attacking 5 different blocks that I want to make sure that you guys are in sync with them in order to build like this self-funded growth story of Creditas. Building stable and predictable gross profits as a priority number 1 for us, gaining scale and operational leverage. So this is a game we believe of scale. Without scale, you cannot win in financial services. Pillar number 3, technology. And now AI for the last year has been like a critical part of our agenda as a way to reduce cost and cost of growth, and then therefore be able to grow without consuming capital. Bottom left, financial optimization. The Erika's team in capital market has been working relentlessly to have like a more streamlined process of securitizing the loans, and then finally creating a hyper-focused winning team with the latest addition of Ricardo Forcano that has come in with a vast experience at BBVA, where he did the technology transformation, huge experience. He's helping a ton already. We are building like a very solid foundation to continue developing new and exciting things at Creditas. Just a couple of notes, and then David, I will pass it to you for the Q&A. NPS continues being like one of our key metrics internally, just making sure that people love what we do. Remember that this is a very complex product that people is not aware of that exists. Nobody knows in Brazil that you can take a car equity loan at a fraction of the cost of a personal loan, and that you can do it from the comfort of your home. So this remains very relevant. And remember that the rules of the game are changing now with AI, and obviously very passionate about what we are delivering there. Technology at the core of what we do. On unit economics, what you see on our financial releases is the right-hand side. What we see when we manage the business is a lot on the left-hand side. The right-hand side is financial statements according to IFRS, where you have front loading of provisionings. Today at 14.7% margins on portfolios, which roughly stands to be like at 37-38% gross profit margin. And then on the left-hand side, cohort profitability, if you can see, remaining relatively strong through the whole 3 years after we completed the transformation. So this 20 to 25% credit margin in terms of a spread versus portfolio is the way that we feel comfortable with. If you look at the chart on the left and look at the latest cohort that we published results, we're doing loans at roughly 49% APRs with cost of funding at 13, and where we deliver 22% spread on that product. So remember that the industry, as we were mentioning before, had the competing product is priced at 141%. What we are doing is slashing that price to 1/3 of what customers are paying today, but still having like a very interesting margin for us that pays for the customer acquisition cost. On that note, I'm going to talk about CAC because this is one of the things that we focus the most inside of Creditas. We want to build a low-cost producer, and the only way of doing this sustainably is by investing heavily in technology. The chart on the right, you can see how the company has been evolving. So 5-6 years ago, we were having customer acquisition cost at 20% plus of the loan volumes, and with significantly lower volume being originated. Today, we are very close to reach the 10%, the 10% mark, which is going to be, we're going to throw a party when that happens, because we have been always eyeing to that number, and that's just a point in a very long journey. We still believe that this company can run with CACs at close to 5% in the very long term. So still have plenty of room for improvement on that regard. In the middle, channels play like a very crucial role, and how do you attract your own audience? The two blue bars that you can see at the middle chart, it brings you like a story of the customers that we have been amassing over the years, which now are getting close to 14 million registered users, and that progressively we are onboarding. And I want to leave you with one final note, which is on productivity. And this has always been at the focus of our work. Now more than ever, this is becoming like one of the critical metrics. I would say that today, gross profit and productivity per individual are the two more relevant operational metrics that we follow. 4 years ago, we were generating roughly like 100,000 reais per individual. Today, we have reached close to 1.2 million reais per individual and year. Remember that the salaries in Brazil, to put it in perspective, on average are roughly 35,000 reais. So that means that the employees are paying for themselves, and everything that we are doing is investing in the creation of massive portfolios over time. And with that, Dave, I'm gonna pause. I think that I met the 15 minutes target.